Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the No Trader show on StockCharts.com. Well, U.S. equity markets are under some decent selling pressure this morning as China has tempered optimism for a trade deal. As we speak, the S&P is off about 34 points, and that's about 1.2% or so, all within the first 2 hours of today's trading session. U.S. bond yields, and when I talk about bond yields, we're talking about 10-year treasuries, are back down to about 1.52%. So that's only about 6 or 7 basis points off of this year's lows. The dollar index continues to hover near 99, and gold's up about $4 or so at 1508, give or take. If we look at the stocks that most impacted the rally over the past 4 years or so, um, they were no doubt what people have come to know as the FAANG stocks, a mnemonic developed to represent the high-flying big-cap tech stocks of Facebook, Amazon, Netflix, and Google, which is now called Alphabet, but that's the G in FAANG. A few years ago, I myself included Microsoft and Apple into this group, so I renamed them MAFANG. And today what we're going to do is take a real in-depth view of these six stocks and where key levels are in each of them so that we can kind of get a sense of what these previous leaders look like now and whether or not the market can make new highs if this group is not participating. And also in relative terms to the S&P, what it looks like. So we've got a good show, but a very concentrated show this week looking at these big six high-flying names. So before we get there, let's take a look at the comparison of how the S&P 11 macro sectors are in the past week relative to the week before. By the way, to contact me, and I get several emails a week, so this slide is worthwhile. It's rick@inthenotrader.com, and our website is inthenotrader.com. We've got a ton of videos up there that you'll find interesting, information on how to subscribe to our weekly newsletter specifically geared for individual investors. Most of you know that I've spent my career on the institutional side, but about a year and a half or so ago, I started inthenotrader.com and the newsletter so that individual investors have access to institutional models that they otherwise would not have access to. And my goal here is to get you thinking and looking at markets the way institutions do, as compared to a much simpler way, which sometimes gets the job done, but more often than not doesn't. And it's because you're not playing where institutions are. And of course, the retail crowd has a push of how markets can move, but the goal really is that you want to align yourself with what institutions are doing. And that's what In the No Trader newsletter is about. And each week we put out a tactical trader report that reviews what's going on in the S&P and then digs down and finds a new ETF idea to trade and updates all the other open ETF trade recommendations that we have. So that's the tactical trader report available on In the No Trader. So let's take a look at this past week in the S&P through yesterday's close, year-to-date performance that each one of the 11 sectors has relative to the S&P. If it's above the zero line, these are outperforming the S&P year-to-date, and if it's below the zero line, they are underperforming. And what I do is I put a red dot next to each one of the sectors that has moved 1% or more in relative terms over the prior week. On the left side here, we have the same chart we used last week. We slid it over to insert a new one for this week. Interestingly, last week there were only 4 of the 11 sectors that had moved much over the week before that. This week, 9 of the 11 sectors have made enough movement that they have moved 1% or more in relative terms to the S&P from the prior week. And We'll start off with, normally we just make our way across, but you'll notice one of the red dots is much bigger than the other ones, and that's because the energy sector, which is kind of square in the middle of the screen in the bluish green, is down now 15.46% versus the market this year. Last week it was only down 12.8. So this had kind of a significant decline over the past week. I got this call wrong because at the beginning of September, I thought that energy could finally hold its own against the S&P for the balance of the year. It did for a few weeks, but topped in mid-September, and once again has made new relative lows to the S&P. So those relative lows are not only 2019 lows, but they're actually the lowest lows in relative terms in 19 years. So the energy sector continues to be the dog of the U.S. equity investing space. 8 out of the past 10 years, it has underperformed the S&P. And again, in pure relative terms, you would have to go back to 2000. So, and the way I do this is I'll take a chart of XLE, which is the ETF that tracks the S&P 500 Energy Index, and divide it by the SPY. And that will give you relative performance. And if you pull that chart up yourself, you will see that in relative terms, we have not been at the levels we're at now since 2000. So it has been a horrible, horrible place to invest in over time. Yes, you might have made some money being in energy stocks, but you could have been in any other sector and done better than being in energy over the last 10 years or so. So these again have made new relative lows. Crude oil obviously gave back all the gains that it had from the spike up when the Saudi oil field got bombed, must be close to a month ago or so. And oil sits in the $52 range right now, having peaked at 63 and change. And that has just put big pressure on these names. They were already doing lousy, and they continue to make new relative lows. What else changed? Well, let's start on the right-hand side. Real estate is up 12.34. It was up 10.8 or so last week, so that picked up some good relative performance. Financials fell from being slightly above benchmark level of being outperformers to down 77 bips. Utilities picked up over 1% on the upside, now outperforming by 7.5%. Healthcare, the second worst sector, did actually pick up over 1% last week, now only down 12. It's still a rough year in that space, but not as bad as it was. Staples didn't move enough to make any material difference. Speaking of materials, let's look at the material sector, down 4.46. They were only down 1.77 the week before, so these really got hammered last week also. Industrials up 1.38 from having been up about 3.7, so they gave back a fair amount as the market got hit. Technology also only up 13.5%. But they were up 12.5, so it actually had a week of outperformance, picking up a full percent. And lastly, communication services up 3.25% this year. They were only up 2% the week before, so they've picked up. So we've seen a shift again, energy getting hit the most, and materials getting whacked also. So now let's shift to our charts. And let's start off with the S&P. So as we are recording this right now, the S&P is sitting at 2,900, right near the lows of the day of 2898. So they gapped down this morning again on concern over trade negotiations with China. And headlines are going to be flying back and forth this week as negotiations are supposed to start up again tomorrow. But investors are not pleased when we have anything coming across negative on this. Looking at the kind of the bigger picture here, we looked at it in July. The market peaked about a week after we had the daily sequential 13 signals right near the top. You'll see the day we actually made the all-time high is right up against the risk level. hold on a second, my cursor, well, I can't find my cursor, but we sold off into August. We recouped and somewhat tested the highs over the 3,000 level again, this time on a setup 9 count. For those of you who are tuning in for the first time, when we talk about some of the differentiation of what we do compared to other people, this model is an institutionally followed model developed by a gentleman named Tom DeMark. Go back to my my StockCharts.com videos from January 29th of this year, which was a Tuesday, and the subsequent 3 Tuesdays after that. So those 4 weeks in a row, I spent a good amount of time going through what this model is and how it helps define exhaustion of trend when it actually occurs, as compared to almost any other model that often comes well off of a peak or a bottom before it gives you the signal that there's a trend reversal. So now we're getting back to the uptrend line that from the June 1st low. We poked beneath it last week, but we didn't close beneath it, and now we're essentially testing it again. We have told our clients that 28.88 is a hugely important level, and you need to get a qualified and confirmed close beneath it. If so, it opens up the door for a move under 2,800 and potentially all the way down to test, let's say, the double bottom we have from March and essentially June 1st at right around the 27.25 level, and possibly all the way as far down as about 26.60 or so. I'm sorry, 25.60. So this is hugely important. It's how you break this level that is the most meaningful. If it closed beneath it today, like in August, where we closed beneath that level multiple times, it will not get a sell signal because yesterday was a down close. We need to see an up close followed by a down close beneath 28.88 and followed by a gap lower open, and then you finally have this signal. So we've just made new lows now as I speak, and you'll see that the S&P is starting to break further. But that's the way we play it, and that's often the way institutions will do this too. So we often don't get out of something just because a trend line breaks or a moving average breaks. It's how it breaks it that becomes more important than just on an absolute level breaking something. And again, it's a little more refined. It takes a little more work on your part to see when levels break, but you have a better chance of thinking in terms of the way institutions do as compared to individual investors who don't necessarily have the schooling to understand some of that modeling that more sophisticated traders might look at. All right, so that's that. Oh, so on the S&P, I mentioned, if we get this qualified break, where we could go on the upside. There are no buy. I don't see any areas listed right now as buy areas on strength. They're simply on weakness. So depending upon how the market does against this level now will determine. Here we go. So depending on how we do against, well again, 28.88. That's the key level we're going to pay attention to, how the market reacts and how it breaks it. On the upside, otherwise, again, I see nothing here. I could draw a trend line down, but I don't think that would necessarily be the key breakout to an upside now. Certainly, you'd want to take out yesterday's high just to get a little near-term positive feeling. And look, the longer we stay and hold the summer lows, the better. But with a double top in place, and we had clients lighten up right into this 9 count here, light and long exposure, and in the no trader clients, then we've at least kind of played this, because both times we got north of 3,000 in here and in July, and then again in September we lightened exposure right near what now still remains a potential double top at the all-time highs. All right, let's move to the FAANG names. And so let's start off, again, I'm starting off with Microsoft because to me, it's really FAANG should be the right way of looking at it. These 6 stocks are the drivers, and not to include Microsoft and Apple in this, in the FAANG names, I think missed out on things. So what we see here, obviously, this is one of the darling stocks. It has continued to make, in fact, just 3-4 weeks ago, we made an all-time high at 142 and change. Notice that was a propulsion exhaustion level, so that was a level that we could anticipate, certainly along with the 13s that we saw coming up, that had shown up over the summer. At this point now, I would say the key levels to look at are Friday closes beneath 131.25, probably gets you down to the 50-week moving average of 122-ish, as well as down to, let's say, 120 and change, which is where the exhaustion level, what we call the full exhaustion level, is on the downside for a propulsion move in this direction. In order to get bullish here, you'd really have to get probably above 147-ish before you could then break out to get numbers into the mid 150s. That's looking at a weekly chart of costs. We had a high level MACD cross months ago I guess a couple months ago, that somewhat lined up where these exhaustion signals were. So that's at least been working. And one of the things to remember too is when you have, markets move in 3 trends. They move up, they move down, and they move sideways. And when you get an exhaustion signal to an uptrend, which is what these 13s are, we've then, since that it's happened, we've gone 2 months without going anywhere. And that essentially makes these signals good signals. You don't have to fall apart when you have an upside exhaustion signal. You simply have to change doing what you were doing. So if the market was moving higher and you get a signal that says upside exhaustion of that trend, if you then go sideways, this properly identified the change in trend from what had been upward to sideways. So just realize that, when we get these signals, it doesn't have to mean that the market's going to fall apart in the opposite direction, or if you get a 13 buy signal that it's going to rally huge. It just probably means that the likelihood of the continued trend of what had been underway is lessened. So that's the way I'm seeing Microsoft right now. Let's look at Apple. And Apple tested this week. We got up to almost 230, right? The all-time high is here at 233. So we got very close. Is it 233? What's that say? 233 and change. So here's a signal suggesting potential upside exhaustion. It says if you get above 231.5, then this signal was wrong. So far, we kind of gone very close to it and haven't broken through it. Even if we break through it, again, it's how you break through it that would determine whether or not you'd actually be stopped. So in this case, you would need to see a weekly down close. So if, let's say, we closed out the week right here, then this Friday, and today was a Friday instead of a Tuesday, then this weekly close would be less than last week's close. So that's a down close. Then if next week closed above 231.51 and the following Monday gapped higher and took out anytime the following week took out last week's high, next week's high, then you'd properly break through this level. So again, this takes a little work, and watch the videos, and I'd say tune in each week because we're always looking at this model as part of how we identify what's going on in the markets in a different way than most people do. So is there a chance for a double top here in Apple? Absolutely. All depends on what comes next, but we have tested the highs this week. You don't have to test the actual high. We're close enough. We got $2 away from it. Certainly a test. Key levels to look at now are 207. Friday closes underneath 207 that are, again, qualified and confirmed. Then open the door for a decline right down here to about 184. So certainly if you're long Apple, as many people are, it's this becomes the 207 level, becomes the key level over subsequent weeks, and as long as we stay above that, we're okay. If we break down underneath this then properly, then you open the door for further declines, and you have a better chance here that you actually do have a double top. Let's see what else we see. The uptrend line off of last Christmas's low right now is near 193, give or take or so, but by December, that's kind of the same 207 level that this is right now, the propulsion level is. So over the next few months, that makes, as we get into December, if we haven't broken under 207, that makes that level that much more important as we head into year end. Okay, now let's get to the classic FAANGs by using Facebook. And Facebook also, when you look at it, the big reversal week off of the all-time highs of 218 and change, almost 219, that took place in July of 2018. That's when this name peaked. So over the summer in July, we got to what do we have here? 208 and change. That's enough to say that that's to me certainly in the ballpark, and even that bar's range certainly intersected the bar's range of what made the all-time high. So we can say that we've certainly successfully tested the high without having broken above. Key levels now are 216.60 on the upside, need to break through that properly to then target these numbers here at 236 and 258. On the downside, things get a little dicey if so right now we have a down week relative to last week's close. Again, if this Friday we close under 180.45, no, actually up close this week we would need to all right, we're beneath the propulsion level already, so this would qualify it. So up close last week qualifies it. Down close this week beneath 184.76, which seems fairly likely at this point. But again, it's only Tuesday. So if we close this Friday under 184.76, gap lower this coming Monday, and anytime next week trade lower than this week's low, you get a fresh sell signal with a downside target of about 160 and a half-ish. Which is very close to the TDST line here, these red dots at 159.28. So that would be your first target. Your secondary target is actually beneath last December's lows on a bigger sell-off. So that's Facebook in the near term. On the downside, on the upside, if this week closes less than last week's close, and then turns around next week and closes above 194.50, gaps higher the following Monday and trades higher than next week's high, that becomes a propulsion buy signal. It says the physics have turned around and hurdling 194.5 with next target 215.91, which again is also very close to this TDST line. So somewhere between 216 and 217, look for resistance, and then breaking through there again targets those two levels up here in green triangles. So look, this is kind of in the middle of the range that it's been since it peaked. So anything you do now, you don't really have a huge edge to. So you want to see a signal, at least the way we look at things, you want to see a signal show up. There is a near-term negative bias because we broke the uptrend. You're in a down count here. But know that there's going to be some support near 160. And right now, some resistance likely near 184.5. So it's kind of tough to do much in between here on a bigger, longer-term basis. All right, let's take a look at Amazon. Amazon's all-time high is 2,051 back in September, just a full year ago. We've tested the high. We haven't broken through. In fact, this line, these blue dots said resistance was at 2033, and this year's high is 2036. So we tested, hasn't broken through. this trend line is actually not a valid one. So let's get rid of it. So most important here, if you look, is the cloud. I would say the cloud model. So for those of you who know the cloud model, there are 5 lines involved, but for right now, I'm probably going to pay the most attention to the cloud itself. That's this shaded zone here. Go back to, this is February of 2016 when the whole market bottomed in February of 2016. Amazon sold right down to the top of its weekly cloud. That found support there, and it's been above then ever since. We got down in last fall when we had the Christmas sell-off last year, and Christmas bottom, and now the bottom of the cloud is what held the support, and we turn around, come out through the top of the cloud, and again go back into bullish mode. Now we're starting to get heavy on the top side, and the two things to look at are weekly. I would say the most important level on this chart right now is 1586. That's where this dotted line is. It happens to be, and purely coincidentally, the same level as where the bottom of the cloud is for the lagging line, which is this blue line. This blue line is current price pushed back 26 bars. If price breaks beneath the cloud, that would be the first time things have changed in this whole rally. They were looking back over several years. If then the cloud's lagging line, this blue line, breaks beneath its cloud bottom, that brings you into sell mode. And that would open the door for a move down all the way to near 1300 in Amazon. So you're going to have critical support at 1586 if it comes into play anytime between now and year's end. So that's the real level to pay attention to. If we hold somewhere in here, turn around, you need a qualified and confirmed close above 1867 on a Friday closing basis to then project a test back up here of the old highs and then way higher at 2413. So really important to know. What do we have next? Netflix. Netflix is the weakest of the FAANGs. It recently actually did a setup 9 count, 9 consecutive Fridays, closed less than the close from 4 Fridays prior. That pattern bottomed Netflix here last year. It bottomed Netflix all the way back here in January of 16. And it may or may not be doing it now. It also just touched the TDST line here at 256 and change. We're getting a bounce. It needs to get properly above 291 in order to get it back as a target of 329. This is kind of really important because last week was an up close. If something happened between now and Friday that we closed this week below last week's low, then you're going down to test the 200-week moving average as well as potentially 194. So got to really pay attention to all these highs up here near 375 and the potential double bottom in the 2.25, 250 level. So that's big stuff. Last, GOOGL, Google. All right, so we look at the L shares, GOOGL, and so this made all-time highs earlier this year, sold off to, again, 9 bottom, just like it made a 9 bottom here, just like it made a 9 bottom in February of 2016. So right now, for bigger picture, on the downside, 1,022 really important, and otherwise this is pure trading range. On the upside, you've got to properly get above 1299 or 1297 in order to next project to 1346. So a lot of these names are kind of mid-range, like the market is, but there are a few that stand out as better or worse, and those are the ones to focus on. That's our show for this week. Hope you picked up something good out of it. Again, I'm Rick Bensignor for In the Know Trader.